a man who needs no introduction. Welcome, sir. I would just take a moment to introduce myself. I'm Charmi Shah, and I'm a part of PMS AIF World. And I'm taking this opportunity to interview today. It's a great honor and an immense pleasure to do this today. So I would just like to begin, sir, on a note that equity markets today have started gaining momentum. How we've seen about 2 or 3 years of a lot of calm, a lot of chaos, and about all mixed emotions in the equity markets today. But today, the markets are showing some momentum with respect to gaining new highs today. And in this kind of a particular scenario, growth investment or growth style of investing over the past 2 years have seen a certain amount of underperformance, and that I know is a certain side of investing that ASK has its niche in. So moving forward, how does ASK today, plan to address this challenge and capitalize on future opportunities that the markets today are throwing investors with?
Any investing ultimately is not conceived in vacuum. Your overall thesis boils down at an individual stock level, at a micro level, stock specific level. Broader economy, markets, uh, many other trends, geopolitical factors. These are constant backdrop of any investing, but investing eventually is at a micro level. It is that particular business, whether it is going to grow or not, whether the growth will be meaningful or not, and whether it will be durable or otherwise, whether it will be predictable or otherwise, and whether the growth will be superior quality growth or not. It is these ideas which put together, which are at a core of value creation. Therefore, if you are trying to distinguish growth investing from something else, ultimately all investing is into the businesses which are going to grow. So there is a popular dichotomy between growth and value is something which I have not comprehended. Ultimately, businesses have to grow. Without that, adequate value creation cannot happen. The quality of growth has to be sound so that value is enhanced. Value is protected as well as enhanced. And finally, it has to be bought at a meaningful price, at a price which is reasonable compared to the underlying value. And therefore, you are hoping to get all the three levers. There are two: annuity and one third factor, which is one time. The annuities are the future earnings growth or the cash flow growth. The second annuity in the future is the quality of growth. And the one-time factor, which is the third one, is the margin of safety. That is the gap of the price compared to value today. Price today compared to value today, which may be one-time benefit, not an annuity, but it unfolds over the period of time. Therefore, all the three you are hunting for in any meaningful investing, all of the three are integral ideas. So I do not know, exactly what, why would we say growth is niche or growth is a particular style? Ultimately, businesses, if they're not going to grow, then there is only one pony trick where there is a margin of safety. If it is there, then that is the mix that you can hope to get. But if the businesses are going to grow and the quality of growth is meaningful and superior, then you get additional those two levers. And why would any investing deny itself that?
But considering today's scenario where valuations are attractive but still certain stocks are expensive, given such a situation, where is the stance on margin of safety?
You have answered yourself. There are stocks which are at a higher price than value, maybe. There are other stocks where prices may be relatively more attractive compared to the underlying value.
Hmm.
And it is a job of any hardworking, conscientious investor to find those that would offer a reasonable value. Of course, along with the other factors such as the quality of the business, the character of the management, the kind and the strength and the size of the growth, the size of the opportunity, the quality of growth. All of those factors in the backdrop are important too.
So
But in any market, there will always be something which is probably cheaper than what it deserves to be, and there'll be something which is perhaps more expensive than what it deserves to be. That is a forever meandering river of investing, ups and downs of not all stocks are always in a same basket where they are generally cheap or generally expensive. Of course, when markets are unduly high, in general, most stocks are likely to be higher than their value. And in general, when markets are particularly underpriced, then most stocks are likely to be cheaper than the value.
I remember that in one of your videos I did hear that one perfect analogy that size of the pond matters the most. That is the first question, and the second thing is whether the fish is capable or not is the next question. So given that, has ASK's investment approach today changed in identifying those fishes after the COVID or the pandemic event that we witnessed in the markets, or how is the flow addressed?
Why would it change? I mean, what will ultimately, you want all the elements to play together as a symphony, and together they enhance the value. Each individual element contributes its own value. They together become a symphony, and then there is an extra value that it delivers as a system together. So you want a quality business, businesses which have potential to create superior value. You want to ensure that the managements represent quality and standards, which will help in enhancing and continuing with that value creation process. You want to see the large size of opportunity so that there is a headroom to grow. If the size of opportunity is limited, if the pond is small, the headroom to grow is limited, and growth, as we discussed earlier, is a very important integral element. Without growth, ultimately nothing in the nature remains the same. There is no status quo. If things don't progress, they regress over a period of time. And therefore, over a period of time, growth is important. Therefore, size of opportunity is an important idea. It talks about, spells out headroom to grow. But that headroom to grow has to be capitalized by the good management with its capability, with its vision, with its ability to carry things through in a meaningful way within that size of opportunity. And therefore, just the large size of opportunity is not enough till it is ignited with superior quality of the strength and resilience and fire in the belly of the management to extract that opportunity and convert into an outcome. That outcome eventually reflects in the form of rate of growth in the future. And the quality of growth, which is capital efficiency, allows the conversion of the growth into the returns in a more efficient way, where you enhance the underlying growth into a return higher than that. The difference comes from the quality of growth. You may not always be able to pinpoint it or put your fingers on it, but it is very much there. Else, why would there be businesses which generate X amount of growth over long period of time, but generate returns which are higher or lower than that? And the difference comes from quality is an addition or deduction. So whether you see it or not, or whether you appreciate or not, or whether you can kind of get a identification of it or not, it is always there, and it is the job of an investor to understand the quality. And finally, all of that package has to be bought, has to be converted into a vision of what you think is the value. That value is not a static number that cast in stone. It's a moving thing with the new insight. The value in any case expands with the time itself, because future is discounted to the present in order to arrive at a value. Therefore, automatically as you move into future, value compounds with the time. But apart from that time compounding, value will change with the new insights, new understanding, new factors, new dynamics which emerge. And it is, as an investor, it is your job to focus on all of that, to keep evaluating and keep refining, re-refining your view, rectify any errors of judgment made in that, or improvise on whatever you have judged is a constant job. And finally, the discipline to buy it at a margin or some margin of safety. In generally weak markets, you may have an opportunity to get a larger margin of safety in general. And in generally very bullish markets, your margin of safety in all probability is likely to be relatively low, in many cases non-existent or negative either also. But all of that remains together. Each element is vital in itself. All the elements put together form a symphony of its own, and you need every element to be there and to play its role well. And you need the symphony, which is in the form of the final position or the stock, to also do its due. And therefore, this is not a tactical thing that changes in is a flux of time.
Right. So we touched upon the management part of it. Bharat bhai, we figured out, the concepts or the parameters that we look at when we are picking a particular stock, or when an organization is picking up a particular stock. So now moving forward with respect to investors' point of view, I understand that ultra HNIs and HNIs have their bias towards a particular asset class, and when that comes in, they might come to alternatives as a solution. But despite that, certain AMCs like White Oak and Alchemy, they've started focusing on mutual funds as well. So is ASK also looking to digress in that particular transaction, or what is the stance there?
Well, each one is a choice, and all of these are formats of managing investments. So we constantly evaluate all the different formats through which we can channelize our investing. So mutual fund remains a viable form of managing investments. As much as PMS is, or so is AIF. These are structures, and we remain interested in all the different structures, which will eventually help in managing those investments for the different clients in an efficient way, and which makes adequate and more than adequate sense for the clients, which comes first, and it must make organizational business case as well. So what others pursue is part of their strategy. What we pursue is part of our strategy, where all important formats and the structures of managing remain important.
Correct. But my question comes from the point of view of this trend that is coming in with respect to AMCs wanting to set their foot in the MF industry as well. And earlier, they were only considering or catering to the green crowd in the alternative investment space. So, what do you think can lead to such a divergence in trend? And are UHNIs comfortable investing into MFs when their net worth crosses a certain amount of?
Well, I can't give a very generalized answer to that, in a sense that whether high net worth individuals have affinity for one or the other. Of course, there are preferences, and it gets expressed in the form of the investments that they choose. But as I mentioned earlier, all the different forms of the investment, so long as they are efficient vehicles for investment, most importantly, they must meet with client needs in an elegant and appropriate way, because that comes the first. And finally, it must make a business sense, and each one evaluates their own choices.
Correct.
So I have no comment to offer on what others do. But as far as we are concerned, we remain interested in all the formats, and we continuously analyze and we build. I mean, we did not have a AIF at a point of time, but we do have today. And therefore, there are choices which are appropriate, and where trinity of objectives is met. All those formats will be of importance to us.
So speaking about AIFs, given the indexation benefits that recently got removed from debt mutual funds, a lot of HNI investors again started pivoting towards AIFs, and especially the fixed income space within AIFs as well. So, is that a trajectory that ASK is probably looking to open up in the space of AIFs? Like, given the performance or the favorable conditions that we have in the debt space today, is ASK contemplating entry into this market?
As a part of ASK Investment Managers, we do not have currently any plans to launch fixed income AIFs or fixed income solutions, not as a part of ASK Investment Managers. But our other group structures, some of the sister firms, do offer solutions on the fixed income side, either sourced from the others or manufactured by themselves.
Perfect. So, given today's economic stance that we are currently in, what are two insights or two sense that you would like to share for investors when it comes to investing in India as the macro outlook? Because we all understand that everyone today is not saying, we used to manifest that this is the decade for India, but today we've come to a conclusion that this is going to be a century for India. So, having said that, what is the asset allocation that investors should look at today, and what opportunities should they tap on given the current scenario?
Much like 1 or 2 years is too short to forecast and make any meaningful judgments as far as investing is concerned. 1 century is too long for anybody to comprehend. At least I don't have competence to forecast over some century or 100 years. I need to be some kind of reincarnation of God in order to be able to make those kind of long-term forecasts. But in more practical realm, any good investing would encompass some kind of an outlook of a decade or two or more, and that is both in the practical realm as well as it is important to conceive from an investing point of view. I believe we as a country are at a threshold of one of the greatest economic expansions than at any other point of time in the past, and that too on a larger base. So we just ended the last year with an economic size of about $3.75 trillion. And even the market value today roughly is in the same band at about 3.6, 3.7 trillion US dollars. So uh, we are already the fifth largest economy, and as much as I can see the numbers, we are also the fifth largest market in the world. I definitely believe that maybe before 5 to 6 years pass up, we would see the economy, which is definitely the third largest in the world. and in all probability market also, which is the third largest of the world. The first one is more in the realm of definitiveness. The second one is more in the realm of supposition. But I think both the size of economy as well as the size of market, I definitely believe there are many, many reasons why from the fifth to probably third in each of them would occur in this 5 6 year period, if not actually earlier. And if you take a bit of a longer term picture, you take last 10 years or last 20 years or last 30 years, India is figured as among the top two markets in dollar term returns compounded over those respective periods in the world. The trophy is alternated between India and America. Whether you take last decade, 2 decades, or 3 decades, and therefore India is prominently featured in both of those, in each of the periods in the top two slot in dollar compounded investment returns of the markets. Uh, I think there are plenty of reasons to believe that the period ahead is likely to be more productive, both in terms of the strength of the economic growth and therefore the performance of the businesses and therefore the value creation. I also believe qualitatively we are on a sounder footing. Therefore, that rate of growth will be further enhanced in terms of the return generating capability by a superior and rising quality of that growth. Therefore, the two aspects put together, I believe it will be a rising crescendo going ahead, higher economic growth and superior quality as well. The two together have to reflect into the performance of the businesses, their cash flows and the profits and their value, eventually the wealth of the promoters, and finally the returns generated by investors who are patient, long-term, wise and disciplined. Therefore, in my opinion, we are at a defining moment in the journey of this country's economy as well as the markets, and both uh, foretell a story of very exciting opportunities ahead. Um, and I'm not really talking of some 2 years or 3 years or 5 years. I'm talking more in terms of decades, 10 years and 15 years and 20 years, and if not more. Therefore, in all probability, we are at a cusp of one of the most important defining moments in the journey of the economy, of the markets, of the value creation by the businesses and the owners of those businesses, and eventually the investors into those businesses in the markets.
But when we say that India will surpass or become the third largest economy, we are still a long way to surpass China. How are we standing today, and what are we doing right to rapidly grow in that area as well?
Have we looked at last 30 years and how Chinese markets have returned and how Indian markets have returned? I mentioned that if you look at last decade or 2 decades or 3 decades, in each of the periods, India is featured in the top two markets of the world. What does it show? That India may not have grown at the rate at which, yes, China has grown at a rate faster in last 30 years. But economic returns, investment returns in India have been way ahead and way superior to what Chinese markets have generated. What does it tell you? That ultimately it is not just the economic growth of the country, it is the quality of growth, solidity, reliability, predictability of that growth, the character of that growth, which is very important for value creation. Economies love the idea of GDP size and growth rate, and often they get carried away with those nuances. Markets are more focused on the value creation, capital efficiency, predictability, character of growth, and ideas like this, and which are important underpinnings of what any good investing is all about. Therefore, certainly, as far as GDP is concerned, China has grown at a meaningfully faster pace. Over the last 30 years, China has done 13% GDP growth rate, and India has done about 8.5, significantly lower in in nominal economic GDP growth rate terms. But in terms of the market returns, India has produced over 30 years some 8.2% in dollar terms, 8.3% in dollar terms. Chinese market numbers have been barely at about 2% compounded over this 30-year period. That tells the story. I do believe Indian economy will grow at a rate faster than Chinese GDP. But that is not the only lever for value creation in the markets. But it's an important lever. Therefore, I believe rate of growth for India will be superior going ahead. Even more importantly, the quality of growth is likely, in my judgment, superior than the past. Therefore, the two together form a rising crescendo. And therefore, we will reduce the gap in economic size between the two countries. But in terms of the market returns and efficiency, India is already well ahead.
Bharat bhai, you've had 3 decades of experience in the industry, and you have witnessed different levels of bloodbath in the markets, different levels of markets reaching high today. What is that one constant investment lesson that you take away from all these kind of events that you've experienced in the Indian equity markets?
Well, ultimately, it all boils down to an investment philosophy converted into a kind of a framework and a methodology, a strategy. Then it boils down to discipline of doing it and not getting carried away, especially when situation looks adverse. It is easy to lose the bearings and get carried away to do things that you shouldn't be doing, which then you may regret later on. But in at the moment of weakness, you get carried away by that. Therefore, having a philosophy, having a workable strategy based out of that, and then implementing it with discipline, with character over differing times is invaluable, and that cannot be compromised or sacrificed. Ultimately, investing is not about some macroeconomic judgments. It is not about some geopolitical noise that abounds all the time. It is not even about trying to make some intelligent sounding predictions about market levels, though popular in itself. And all the time, so many different people keep trying to put their energy in predicting market levels. But it's a futile exercise to my mind. And finally, it is also not about riding some thematic gravy train where you try to ride a trend or a theme or an idea. Because when you try to follow a trend or a theme, you get carried away by generality, while investing success depends upon specificity. That specificity is at a micro level, at a particular business level. Therefore, all amount of panditry of a geopolitical variety, global macroeconomic variety, whether global or Indian, all kinds of very dramatic looking forecasting exercises of the future trends and themes and ideas, which ideally we should leave to consulting firms who really really have to be accountable for those trends that they forecast of 10. And so that soothsaying approach, or being a clairvoyant, is very popular but is not a realistic way to do investing. Therefore, investing remains an important micro level exercise. That particular business, whether it is character whereby you have a confidence, whether it will create value, whether it is run by people whom you can trust, both for their capability as well as their governance, whether the business has got what it takes for the headroom to grow. Indeed, whether there will be growth or not, because without growth, all bets are off eventually. There can be temporary period of no growth or low growth or even a negative growth is possible. But a prolonged period of stagnation is a recipe for disaster, and diminution is not a recipe for value creation. Therefore, there has got to be meaningful growth rate belief, and whether the quality of that growth is superior, and whether you can use all the tools of investing, both science and art, to have meaningful forecasting mechanism to judge the value. You package all of this together, and what you do is compare relentlessly that judgment of value with the price. And as I mentioned earlier, value judgment is not one-time exercise; it's a forever evolution and evolving exercise. And time after time, you try to eliminate the mistakes that you made in judgment and try to incorporate into your revised model. Time to time, you embrace of the new emergent likely realities and try to embrace them into your judgment model. While exercise remains firmly in future, but the past and present are like solid backdrops to that exercise, and the right fusion of the two is needed to make the judgment at a micro level. But there is no getting away from the fact that ultimately investing is at a micro level. And all the global noise, geopolitical stuff, macroeconomic noise, all the forecasts that economists love making, rarely accountable for, all the trend forecasting that consulting firms and others keep engaging themselves with, they may have some utility, but as a serious committed investor into the markets, into the businesses, these have to be firmly, all of these have to be regarded as kind of a backdrop, and more often than not noise rather than actually value or a signal. And therefore, investing remains that bottom up exercise within the backdrop of having a sound philosophy, which is chance to create meaningful value creation over a long period of time. It must convert into a workable, crunchable method, strategy, tools that must yield itself into a kind of a disciplined exercise to filter and identify businesses. And finally, all of that risk or management and the prudence that you want to put on the top must also, that risk control apart from at a stock level must apply at an aggregate portfolio level. And therefore, both individual risk of the business and of the portfolio both remain vital and material. That is what the game is all about, and that is where it stays. And so long as we do that and not get carried away by time to time popular noise, popular trends, popular decibel, popular flux that prevails in the market all the time, uh, you have to watch it at times in amusement, at times with trepidation, but you have to do your bidding. You have to do what is right, which will create a long term value, and you have to remain focused on that. None of the journey comes without time to time periods of pain and worries and concerns, and those are legitimate. If we have no fear and no worries, then we become gods and we end up making big errors. Therefore, time to time we have to remain watchful of our own fragility, of our own ideas, whether they need refinement, whether they need to encompass some more that we may miss out, and keep working on that game, keep refining the craft, keep getting ahead all the time. There is no getting away from any of this. But clearly, investing is not popularly what investing is in the TV studios and often into the printed media articles. It is certainly not geopolitical. It's certainly not macroeconomic. It is certainly not some market predicting. It's certainly not riding some trends and themes. But all of these often, in some form or the other, end up getting described as investing in various forms of media that abound. But remaining firmly away from any of that noise while remaining aware of what is going on is the trick, that you remain aware but you do not get influenced by it. You do what a well conceived long term viable philosophy, strategy, methods, selection, and overall management of the risk at the portfolio level, which is built over a period of time, and you remain a true student of that all the time. And markets are very bountiful, very generous, and very rewarding.
Bottom up philosophy, and it's nothing but a micro level service that you have to do investment. So great conclusion, Bharat bhai, to this interview. I am really honored to have had the opportunity to interview for this, and thank you so much for participating in
Thank you,
this.
Charmi.
Thank you.
My
Thank you.
pleasure.
Thanks,
Thank you so
Nazneen.
much.